If you use a credit card, there's a chance compound interest is working against you right now. And the worst part is that most people don't notice it until the debt is already out of control. Because credit card debt doesn't grow in a straight line. It grows faster over time. Month after month, interest over interest. And what looks like a small balance can slowly turn into a financial trap. Every year, millions of people fall into credit card debt believing they can pay it later. But later becomes more expensive, and more expensive becomes harder. Today, we're going to break down how compound interest works inside credit cards, why it becomes so dangerous, and how it can destroy your financial power if you don't understand how the system works. We'll explain everything step by step, block by block. And once you see how the structure works, you'll understand why credit card debt is one of the most profitable systems ever created. A credit card looks simple. You buy something. You pay later. If you pay the full amount, nothing happens. But if you don't pay everything, interest starts. And that's where the real mechanism begins. Credit card interest is usually high, much higher than most other types of debt. Because it's unsecured, the bank is taking more risk, so the cost of borrowing is higher. But the real danger is not just the interest rate. It's compound interest. Compound interest means interest applied on top of interest, not just on the original amount, but on the total balance. Let's imagine using blocks. You start with one block. That's your purchase. Next month, interest adds another block. Now, interest is calculated on 2 blocks. Next month, another block is added. Then another. Then another. The tower grows faster every time. And the longer the debt stays unpaid, the faster the tower rises. This is why credit card debt feels slow at first and overwhelming later. Now, here's the mistake most people make. They think minimum payment means progress. But minimum payment mostly pays interest, not the debt. That means the balance barely goes down. Sometimes it doesn't go down at all. You feel like you're paying, but the system keeps growing. This is not an accident. Minimum payments are designed to keep the debt active longer, because the longer the debt exists, the more interest is generated. And interest is profit for the lender. Let's run a simple example. Imagine you owe $1,000 on a credit card. The interest rate is high. You only pay the minimum every month. At first, the balance goes down slowly, but interest keeps adding new cost. After months, you may still owe most of the original amount. After years, you may have paid more in interest than the purchase itself. Not because you spent more, but because time multiplied the cost. Compound interest doesn't feel dangerous at the beginning. It becomes dangerous with time. Now let's connect this to behavior. Credit cards make spending easy. No cash, no delay, no immediate consequence. That changes how people think. When paying feels easy, spending increases. When spending increases, balances grow. When balances grow, interest grows. And when interest grows, financial freedom shrinks. This is how people slowly lose control without noticing. Not in one decision, in many small ones. Another reason credit card debt becomes dangerous is psychology. When the balance is small, people don't worry. When the balance grows, people feel stressed. Stress makes decisions worse. People avoid checking the statement. They delay payments. They use the card again. They try to fix the problem later. But compound interest doesn't wait. It keeps growing. Every month, every cycle, every statement. And the longer it runs, the harder it becomes to stop. Now, let's go back to the block structure again. Imagine building a tower from debt blocks. Each purchase adds one block. Each month of interest adds another. If you only remove one small block at a time, but interest adds new ones faster, the tower keeps growing. This is what happens with minimum payments. You think you're reducing the tower, but the system keeps stacking. To stop the growth, You need to remove blocks faster than interest adds them. That requires strategy, not just effort. There's also something else people don't realize. Credit card debt reduces future options. When part of your income goes to interest, you have less money to invest, less money to save, less money to build. Interest doesn't just cost money today. It costs opportunity. Tomorrow, money that could be growing for you starts growing for someone else. And over time, that difference becomes huge. This is why compound interest can work for you or against you, and credit cards often put it against you. So how do you avoid the trap? First, understand the real cost of interest. Second, avoid carrying balances when possible. Third, never trust minimum payments as a solution. Fourth, reduce high-interest debt before trying to invest, because a high interest rate on debt grows faster than most investments. Fifth, use credit as a tool, not as extra income. Credit is not money, it's future money. And future money always has a cost. Here's the truth. Most people learn too late. The credit card system is not designed to destroy you. It's designed to make profit. And profit comes from interest. People who understand the system use credit carefully. People who don't understand it stay trapped longer. The difference is not intelligence, it's awareness. Once you understand how compound interest really works, you stop thinking only about what something costs today. You start thinking about what it will cost over time. And that change alone can protect your financial future, because money grows with time. Debt also grows with time. The question is, which one you allow to grow faster? But there's something even more dangerous than high interest. It's time. Time is what makes compound interest so powerful. Let's imagine something realistic. You owe $3,000 on a credit card. The interest rate is high. You decide to only pay the minimum each month. The first few months don't feel serious. The balance moves slowly. You think, I'll fix it soon. But month after month, interest keeps being added. 1 year passes. You've paid hundreds, but most of it went to interest. 2 years pass. You've paid much more than you expected, yet the balance is still there. 5 years pass. Now the original $3,000 has cost far more than the purchase itself. Not because you spent again, but because time multiplied the debt. Compound interest doesn't attack immediately. It waits. And waiting makes it stronger. Now let's compare something important. Imagine instead of carrying that $3,000 debt at high interest, you invested $3,000 with moderate annual returns. After 5 years, that money could grow. Not explode, but grow steadily. Now, flip the situation. Instead of your money growing, your debt is growing. Instead of earning compound interest, you are paying compound interest. Same mathematical principle, different direction. One builds wealth, the other drains it. That's why compound interest is often called the eighth wonder of the world. It depends on which side you are on. There's another hidden layer. Credit cards change how people think about money. When you pay with cash, you feel the transaction. When you pay with credit, the pain is delayed. Delayed pain increases spending. Increased spending increases balances. Balances increase interest. Interest increases stress. Stress increases avoidance. Avoidance increases debt. It becomes a behavioral loop, not just a financial one. The system works because psychology works. Now, think about opportunity costs. If you are paying $500 a year in interest, that's $500 not invested. Over 10 years, that lost investment could have grown significantly. But instead of compounding for you, money is compounding for the bank, and most people never calculate this. They focus on monthly payments, not long-term cost. Monthly thinking hides lifetime impact. Let's build the block structure one more time. Imagine two towers. One tower represents your investments. The other represents your debt. If your investment tower grows slowly, but your debt tower grows faster, your financial position weakens, even if your income increases. Even if you work harder, if high-interest debt grows faster than your assets, progress slows, and slowing progress feels like working without moving forward. That's how compound interest destroys financial power. Not dramatically, gradually. There's also something called revolving credit. Many people never fully pay their balance. They carry it month to month. That keeps interest active continuously. The system doesn't need you to default. It only needs you to revolve, because revolving balances generate consistent profit. Consistent profit means predictable income for lenders. Your consistency feeds the system. But does it build your future? Only if you reverse the direction. The goal is to respect math, respect time, respect compounding. If you eliminate high-interest debt first, you free up future income. That freed income can be invested. And once compound interest works for you, instead of against you, the entire system changes. Instead of paying interest, you earn it. Instead of shrinking financial power, you expand it. The same mathematical force that traps millions can also build wealth. It depends on structure, and structure depends on awareness. Now, here's the most important mindset shift. Credit cards are not evil. Compound interest is not evil. But misunderstanding both is expensive. If you use a credit card and pay the full balance every month, compound interest never activates. The tool works for convenience. But if you carry balances casually, compound interest activates silently. And silence is what makes it dangerous. Because small numbers don't scare people until they become big numbers. The goal is not to fear credit. Block by block.